No, I have to make sure I turn the volume down. I've always loved your hair, Kelly. If I could just sit down and be still long enough to do so. I mean, okay, there we go. It's like you're live before you even know that you're live. But I guess I should just assume that I'm live, even though I don't have access to all of the things yet. Good morning. Good morning. Thank you, Kelly Martin, for hopping into Lender's Lounge. It has been a while. We've been recalibrating some things. It was summertime. The babies was out of school. I have grandbabies that I was taking care of and tending to and hanging out with and trying not to get scarred up, trying to show them Kiki can still hang, baby. Look, so we had to redo the format of some things, but I'm just so thankful and blessed to still have you in the room. I am Makeba Evans, real estate agent extraordinaire, a global real estate agent who can assist in all 50 states and several countries. I'm licensed in Georgia, but I have a vast number of real estate professionals who we team with to help change people's lives with real estate, looking to buy, sell, invest, relocate. All of those involve real estate, and we all need somewhere to live. And most people need to get their homes financed to make that happen. So, Kelly, please briefly tell people who you are, where you are, how they can get in touch with you, and then we will talk about our topic today.
All right, so my name is Kelly Martin, and I am a mortgage advisor, mortgage lender, mortgage banker. Anything dealing with mortgages, that's me, whether it's residential or commercial. I am licensed in 49 out of the 50 states in Washington, D.C. New York is still holding out because, woo, yeah, it's hard to get licensed in New York. I currently reside in Georgia. However, like I stated, I can close loans in every state except for New York.
Love it, love it. Okay. Well, Kelly, tell them what our topic is. What are we talking about today?
So today we're going to talk about million-dollar mortgage mistakes. We're going to talk about six innocent looking decisions that can turn your clear to close into we need to talk. So basically, like, hey, you're under contract, and right after you go under contract, all the way until you get your clear to close, a lot of people make these six common mistakes thinking that they are harmless, and they really aren't that harmless.
Yeah, so let's go through some of these scenarios. And I try to make sure that I'm having those conversations with my clients as they're because it's like a short time span. It's not like years or months. It's situations where we need you to stay straight and focused until you get the keys, honestly, and even beyond getting the keys. But we'll talk about that pre-approval time span. So we have somebody that's gotten pre-approved. We're celebrating. We've done all the things to get them here. They've worked on their credit, their debt to income ratio. They've been employed. They have proper documentation of what it is that they need to purchase a home, and their car breaks down. What is it? How important is this, being able to navigate the next steps of this?
So the car can wait, the closing cannot, right? So basically you're stating, I'm buying a car and it won't affect my mortgage. Oh, yes, it will. A new auto loan can change your debt to income ratio and the deal. So basically when we are calculating your debt to income ratio, it's in order to meet certain ratios based on the guidelines of either Fannie, Freddie, or FHA or VA or USDA, right? Depending on who's going to underwrite your loan. So your debt to income ratio cannot be above a certain number. When you accumulate new debt or when you buy a new car, that's going to add to your debt, which is going to make that ratio go up. And if that ratio goes up, we might not be able to finance that loan. A new credit inquiry and new account can trigger underwriting questions. So a new credit inquiry and a new account can actually lower your credit score as well, right? And even a small payment can matter when the borrower is near their debt to income limit. So, for example, when it comes to conventional loans, which a lot of people, or even FHA loans, let me go because a lot of people go FHA nowadays because the rates are better. You can't go above 57% DTI, debt to income ratio. So if you are at 56.99 and you're like, oh my God, I need a new car, and you buy a new car, that could send you over 57. And if you're over 57, no longer will FHA buy your loan on the secondary market, which means that we have to start all over again when it comes to trying to qualify you.
Right. Got it. And in their brain, they're like, well, I'm paying $333.33 a month. The payment is exactly the same, but they're not thinking about all of those steps that get that credit to be viewed and taken into account for sure.
Well, it might not even, I mean, if your car broke down and you had a car note and you buy a new car, now you have two car notes. So it's not necessarily that it's the same, like you're paying an additional car note like that, and that's definitely not good. That's definitely raising your DTI.
Yeah, yeah. It's a lot. And we're here as the professionals to have those conversations with before, these vital things can happen to totally send you backwards because that's what's going to happen. But they've been pre-approved. Oh my gosh, they went to this furniture store and there was this big sign in the window that said no payments for 20 months, for 12 months, 24 months, 36 months, however many months that is. Oh my God, I can get a house full of furniture before I even have my house. Kelly.
Well, first and foremost, let's not. I want you all to not count your chickens before they hatch, right? So until you sign on the dotted line at closing, you do not have a house. Let's start there, right? Um, Even though you might be under contract, because after you go under contract, you get luckily you'll get conditional approval, right? And we'll have some conditions that we'll need to clear in order to get the clear to close. But until you actually sign on the dotted line, that house is not yours. Do not start shopping for something that is not yours yet. And
Mhm.
again, going back to the whole car scenario, when you get all this new furniture, that's going to add to your debt to income ratio, even though your first payment might not be for 12, 24, 36 months, however long, it's still going to appear on your credit because they have to
Mhm.
run your credit in order to ensure that you can afford this furniture that you're getting. So it's going to change the dynamics of your DTI, which in turn will mess up the deal. But I wanted to go back to the car for a second because I wanted to actually tell you all, as borrowers, I need you all to tell us where all the bodies are buried, right? And I'm saying that because I once had a situation where a couple bought a car before they searched for a home, but
Mhm.
they thought that they would be okay because their first payment for their car wasn't for another 45 days. So they thought that it wouldn't appear on their credit. They thought that they would be fine. Underwriting caught that like this, right?
Mhm.
Underwriting caught it. Again, it shifted their ratios, which means we had to restructure the loan. Good thing is that they weren't at the limit for the DTI, but it still made it so that it prolonged our closing. And nobody wants to take longer for a closing than necessary. So let us know if you have accumulated any debt, regardless of when it was. Let us know all of it. If I'm going over your credit report with you and you notice that I don't say something, please
Mhm.
let me know because
Yeah.
underwriting is going to catch it. And I would rather be prepared to speak on what it is that your debt that is that extra debt than be caught off guard and be like, oh well, I didn't know about that,
Yeah.
because that's a problem if I don't know about it, right?
Right.
So let us know where the bodies are buried.
Yes, the bodies are buried. This is the same thing. We are in a temporary relationship. Be honest. The bodies are buried.
Right.
Definitely. Okay, here's one. So they need to, for whatever reason, transfer $5,000 from savings to checking, and they just go ahead and start moving some money around.
So if the underwriter can't trace it, it may not count. Just know that all money needs to be sourced. All money needs to be sourced. Like I cannot explain that enough. So they need to source your funds used for closing. So if you are transferring funds from say you have mutual funds or something, and all of a sudden you move it into your savings account because your savings account is the account that you're going to use in order for as funds to closing, as funds for closing. They're going to want to see where those funds came from. So they're going to want to see your mutual funds account. If you got a gift from someone and you are transferring it into your account, first and foremost, don't do that. If you are getting a gift, make it so that the person that is giving the gift is going to send the funds directly to the closing office the day before closing, right? So don't have them send them to you. Have them send them directly to the closing office. That way, those funds don't necessarily need to be sourced, right? But however, if it's your money and you are moving it around, please do not use mattress money. Do not use mattress money. Mattress money cannot be sourced, and
Yeah.
therefore underwriting will not accept it in terms of using it for closing.
Hmm.
Um, and if you transfer between accounts, that can create a paper trail and it will need to be explained. So if you one of those people that don't like people all up in your business, do not move large sums of money around because you're gonna have to explain it. That's the whole thing. You're just gonna have to explain it. And if you don't like explaining yourself, then don't do it.
Got you. Hmm. Yeah, don't do it. Look, if you can't do the time, don't do the crime. Look, y'all know I grew up watching TV. Don't do it. Look, the TV raised me, y'all. The TV raised me. I always find a song somewhere, some lyrics to something. Okay. All right. So something that definitely didn't happen. We need to have some alarms set, some reminders, missing a payment on anything.
Ooh, yes. So it's like I missed one payment. I'll catch it up. First and foremost, don't miss any payments. All right.
Miss-
Late payments can create serious underwriting issues. A
Mhm.
new late payment can change the credit profile being reviewed. New derogatory credit can require re-underwriting. And never assume that a payment issue is too small to mention. Pay your bills, y'all. Pay your bills. I don't care if it's $25 that you have to pay in terms of the minimum payment. Pay your bills. Anything small will create a ding on your credit, and therefore underwriting has to re-underwrite it. Pay your bills, pay your bills, pay your bills. All right?
So Destiny's Child. Bills, bills, bills.
Right,
Whoever,
right.
look. Okay, okay. So we got the late payments, moving money, the furniture, the purchasing a new car. You spoke about the large deposits, definitely. Something happened, I heard of happening where a husband and a wife, they came to closing, and whatever layer of lender qualifications happened before closing, and it was shared that the wife quit her job because her husband said she could. Kelly?
Ooh, so I know that a lot of us or a lot of individuals do not like their job. I understand it. I have been there, done that, bought that t-shirt, right? Um, just so first and foremost, I want you as a borrower or as a client, I want you to think back to the pre-approval stage and
Mhm.
how when I was asking you questions, I asked you how long you had been on your job, and I also asked you how long you had been in that field. And that is extremely important, right? Because when it comes to pre-approval, you have to have either been on your job for 2 years or been in the same field for 2 years. So if
Mhm.
you quit your job, that means you have no longer been on your job for 2 years. Also, when I pre-approve you based on a certain income. So, if for example, your income is changing, it goes from, hey, I have an income to all of a sudden I quit my job, I don't have an income, then that means that the debt, again, debt to income ratio, that you're going to hear that a lot from me, debt to income ratio, because that is huge. Your debt to income ratio changes, which means the ratios may go up again, which means we cannot, you're no longer approved for that loan because no longer do you have that income to back it. Income continuity matters. It matters so much.
Yeah.
But say, for instance, you quit your job and you found a new one,
Hmm.
right? A new employer may have a different pay structure. There may be a probationary period. There may be a new commission structure, or it could be an industry change that can create questions, right? So, for example, maybe you made $85,000 a year before and you got $15,000 in bonuses, and now you make $80,000 a year and you get $10,000 in bonuses. Now all of a sudden your pay has gone down $10,000. Although I don't see a lot of people jumping from job to job to make less money, but at the same time, like it does make it so that all of a sudden, like your debt to income, your income is less, so your DTI goes up, right? But even if you made more money, your pay structure could be different and your bonus structure could be different. We don't know for certain that you are actually going to get that bonus. Versus if you were on a different job that you had been on for 4 or 5 years and you had gotten the bonus for 4 or 5 years, it is safe to assume that you're going to get the bonus the 6th year. When you start new jobs, there's no certainty that you are going to get that bonus. So therefore, we cannot include that bonus commission structure because we don't even know whether or not you're going to get it. You don't know whether or not you're going to meet the qualifications to get it. So stay on that job until after we close and then quit the job and get the new and tell the new job, hey, I'm in the process of closing on a home. My closing date is scheduled for this time. Can I start the new job a week after my closing? Right? And then you quit your old job the day after your closing. But just make sure that you do not change when it's all said and done. When it comes to these myths, being boring is the best thing you can do. Don't open any new, I mean, be as boring as possible. Stay
Yeah,
on your same job. Don't open any new credits, anything credit wise, whether it be a car or furniture. Don't move money around. Stay as boring as possible. That's the key. Stay boring.
I love it. I love it. Stay on your job if you want to close with Kelly and me. Hey, we got this. We have two real estate professionals in the room with us, Sonia and Flo. Do either of you have any questions for Kelly before we release her from blessing us in our virtual stage? She does have a meeting at 9 a.m. No pressure.
No, no questions. This was really great, very informative, and I appreciate your energy at this hour. So I don't know what time zone you're in, but I mean, we're East Coast anyway, but just it's good to have that in a lender. It tells me a lot about your professionalism as well.
Well, thank you, Flo. I appreciate it.
Oh, good, good. Yes, Flo is definitely. She has very knowledgeable as well, a teacher, a former teacher, right, Flo?
Yes, sorry, I was finding the mute button. Yes, former
Kelly was.
educator.
Yes, Kelly was too. She's been an educator, an attorney, and now she's with us in real estate world.
Yes, yes, and we're still educating. That's one thing that I've
Yes.
learned. Like it just doesn't stop, you know?
Mm,
Yes.
for
Hmm.
sure. Well, Kelly, if somebody can remember one thing about this conversation, it is fair to say that from pre-approval all the way through closing, any major financial move, they need to call you before they move the needle. Even open the door and peek in, talk to somebody else, call you.
Yes. Do not Google. Don't ask your cousin. Don't ask your auntie and them. Call me before you make any, even minor financial moves. Like
Yeah,
any financial moves you make whatsoever, even if it's paying off a credit card, like just
yeah,
let me know before you do anything. So
that's
that way
true.
I can tell you, hey, that's a great idea, or hey, let's wait until after closing to do that.
That's true. Because I mean, people, yes, they're paying off the credit card, and also it's my money. I can't move it from one account to another. I mean, they would naturally think it's
Right.
still mine. Yes, it is yours. So for sure, even those things that they think doesn't make sense for anybody else, it does in this time period of 30 to 45 days. Come on, you guys. You said be boring. I love it. Be boring.
Be boring. Be as boring as possible.
So everybody know how they can reach you. And of course, it'll be in the description, but I just want you to say it out of your mouth before you go so they can feel your energy, like Flo said.
So I work for Edge Home Finance. You can reach me at Kelly with a Y, KELLY. Martin, like the show, at Edge, EDGE, homefinance.com. And then also my phone number will be in the description as well. But for those who want to hear it, it's 301-806-0959.
Perfect. Well, thank you so much, everybody, for tuning in live and those watching us on replay and in YouTube University. We are here to help change your life with real estate. Buy, sell, invest. We got you nationwide, globally. We are here to help you make that next move. I mean, this is the way that most millionaires are made. So that first property, we're here to make that your first investment.